Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. How are you today?
I'm doing well. I've been waiting for you for a couple of weeks. You were off in Texas last week at a great event because I wanted to talk to you about something that's really been gnawing at me for a little bit. As a multi-investor, who evaluates, deals much bigger than I've ever considered, I just got to talk about the top line. I don't know about you, but I'm seeing rent increases that frankly don't make sense across the country,
Yeah.
right? 20, 30%. And these are in B and C class properties, right? If you're in an A property, you get what you get, I guess. But now we're even seeing this in B and C properties. I've seen some at 50% in some occasions. This makes me very uneasy. It doesn't feel sustainable. It feels very bubblish. I think we're in an environment of stagflation, which if somebody who studied the 70s a bunch is not good. And I think there could be several markets, if not predominantly a lot of markets, that have flat rent growth sooner rather than later. And ultimately we'll have rent drops because you can't squeeze blood from a turnip. And I just don't get it, Jonathan. It does. I can't do the math and get there how rents can keep going up at these bananas levels. Am I missing something? Do you see something I don't see?
No, I mean, listen, they can't continue to go up at these levels unless you have a lot of wage growth accompanying it, right? Because you figure if your wage growth, your rent check is supposed to be no more than a third of your salary, right? So as long as you're getting some wage growth, right, you can get 10% wage growth, you can afford a 30% hike, right?
Yeah.
So that being said, rents can't go up at these levels for long, right? This is unusual historically. I mean, when you're underwriting, right, you're underwriting rent growth at like 3%, 2.5%. That's historically rents pretty much track inflation, and that's kind of historically where inflation has been over the long term, right? So the idea that we're going to continue to get these incredible rent bumps every year isn't realistic, right? And I don't believe anybody thinks that it is realistic. I mean, people still are talking about this like with surprise that rents are continuing to go up to this extent, and they're still rising. I mean, there was Jay Parsons of RealPage put out a chart the other day about rent growth, and it was a very confusing chart because it was actually the change in growth rates of rent growth, which made it seem like about a third of the cities were having rent declines.
Yeah.
And he had to come back and like clarify and say, that's not what this means. It means that
the rates.
The rate they've lost, the rate of rent increase has gone down by 8% or whatever it is from last year. But
that would be a confusing chart if you don't read the labels.
Yeah, but they're still getting 14% rent growth, right? But last year it was 22, but it looked like, but there was still some cities where they were up over last year, right? In terms of their rent growth. A lot of those cities where the rent growth was up were kind of like your smaller tertiary cities that was now spreading there, right? So the big major metros had already had their huge increases, and now was hitting places that were kind of like at the lower end of the scale, right? But nevertheless, rent growth still everywhere at very, very high rates. This can't go on and it will not go on. And I think now rents are pretty sticky on the way down, though. I'll be honest. They tend to flatten. And what professional property managers and large landlords will do is they don't like to lower rent. So they never like to lower lease rent. So what they'll start doing is giving away a couple free months of rent. They'll start out with like, so they'll give you a 13-month lease where you only pay 12 months of rent, right? So first month is free, or 2 months, and stuff like that. That's what they'll do. It's very rare that you actually see rents go down. And when I have seen them go down, it's other than the noise. I mean, sometimes if you're looking at like a CoStar report, you'll see like they went down by 0.001%. That's just a collection of the data noise. But when you see them really going down by material amounts, it's when you have a big recession and you have job losses. And that's usually also very localized, right? Because it's because the factory in this town shut down and like everybody lost their jobs and like, you know, nobody was paying rent, right? So that's different. So I don't expect to see a lot of outright rent reductions. What you will see is flattening, and you'll see concessions rising, right? And so, you know, what they call effective rent may go down, but that's, you know, the goal there is always, as we say, concessions burn off, right? So you give someone 2 months of free rent. After 2 months, you don't have that concession anymore. So concessions go away. And sometimes you use concessions if you have a little soft spot to just boost your occupancy, get it back, right? And you're just taking a temporary hit. But you don't want to reduce that, like your rent's going forward, because then you got to really kind of claw your way back later on to get rent increases, right? Once you've shown that you're willing to reduce the rent, then your tenants know it, and they're going to ask for rent reductions, or they're going to fight rent increases more. So, so people don't want to do that. So, but I still, you know, I think, and again, it's all about supply and demand. So the places that you're going to see rent reductions are where you have oversupply. So we've got a lot of building, and if a lot of building is coming online just as a recession hits, then you'll start to see issues, because those brand new you know, buildings are going to be giving away a lot of very attractive incentives for people to move in, and they're going to be poaching tenants from elsewhere, and then everyone's going to have to follow. If you have markets that have very tight supply already, you may not see a lot of movement, right? Also, it may just depend on the asset class. But I'll give you an example. Like there's only 2 times in my life that I'm aware of seeing rent. In New York City, the only time I've ever aware of there being rent reductions was during COVID.
Yeah, that little window.
The only time I've ever been aware of serious rent concessions was actually after the .com bust, and not because there were a lot of people who like lost their jobs, but because the Fed cut interest. It was the first time it really cut interest rates aggressively to like next to nothing, and everybody was buying houses. It was like a housing frenzy, and so people who were normally renting were you know, buying, and you know, vacancy got all the way to like 3% in New York City, which is, for New York City, that's like a catastrophe when it gets to 3%. But that's the only times I've seen it, and the reason is because the supply is so constrained. There's just not enough housing. But if you go to places like some southern markets where it's very easy to build, and they've always built a lot. There are some markets that have a reputation for being boom and bust markets. I don't know if things have changed because of just the sheer numbers of population, but for example, a place like Atlanta has just had a reputation as being really good in the good times and really bad in the bad times, because they always overbuild. Or, you know, Indianapolis has a reputation as being an overbuilt city, and then some of the Texas was always a little bit. Texas is going to be interesting because there's been so much building there going on that, you know, we'll see if that's, you know, it's always been more sort of slow and steady to keep up with population growth. We'll see what's happening now. But you know, if things turn bad, Vegas has always had a bad reputation, right, for oversupplying the market. Phoenix, another one, you know, oversupplying the market. Some markets where there's oversupply, you will see that happening, but other markets, you know, you won't see it as much. And then it's also kind of what kind of property you own. I mean, there's this kind of mythology about multifamily that says, oh, if you in a recession, you want to own C properties because it's cheaper. And it's a very simplistic view of the way the world works. The reason this, you know, on a kind of like very simplistic, intuitive level, it's like, oh yeah, it's cheaper. In a recession, people are going to tighten their belts, are going to move into a cheaper apartment. There may be some, but here's the thing. Recessions hit unequally, right? Correct. They disproportionately hit people who are working class, working in service jobs, manufacturing. Those are your C-class tenants, right? So people who are in A class and B class don't lose their jobs at anything near that rate. And most of them are just going to stay put. It's not like they're going to say, oh, you know what, it's a recession, so I'm gonna leave my super luxury A-class building and move into this, you know, 50-year-old C-class place because I'm gonna save a few bucks. It doesn't work that way. the other thing that happens is that, because your C-class tenants have lost their jobs, they may be there, they may be signing leases, but they're not paying you rent, right? So whereas your A-class tenants are paying you rent, and your B-class tenants are paying you rent. And this is why another sort of off behind the scenes discussion that we were having during this conference was, is it inevitable as a multifamily investor that you move up, right? Meaning everyone starts out with C properties because on paper they look so good, the returns look so good.
Yeah.
But in reality, what you collect, your returns are actually better on a B property than they are on a C property at the end of the day, when you actually see how much money got into your bank account, right? So it's inevitable that people start off with C because it looks great, and then they move up to B and then even A, sort of as they move into that wealth preservation stage, when they're thinking, okay, I just want to sell everything, buy brand spanking new things at like a 4 cap, but I'm going in at low leverage, and I'm like, my base is enough that what I'm making at 4% is more than enough for me to live on very comfortably, right? And I'm just gonna hold these things forever and pass them to my children. Like, that's kind of like the thought process that people go through as they move up in multifamily, right? So and it's because, like, who wants to deal with C properties, right? They're not the great recession hedge that you think they are. Then they don't even perform that well in good times a lot of the time. So this is a very long-winded way of answering your question, which is that it will be localized. The rent decreases to the extent that they occur will be dependent on market, and they will be dependent on local economic factors, and they will be dependent on the kind of property that you own, right? And then whether you survive or not is going to be based on what your basis is in the property. Bought it a long time ago, you're probably fine. You built in a ton of cushion. Bought it just in the last 2 years and you overpaid because you believe that the hype that multifamily is, the safest thing ever and it's going to go up forever. Well, you may be in a bad spot. So
yeah, there's a couple of things kind of wrapping this up that I think about rent. One is, I've seen a lot of deals here in the last 6 or 9 months with rent increases expectations that I guess kind of made sense. I don't think make sense anymore. I just see an upper bound that people aren't considering, right? So I think rent is going to disappoint on the upside in most markets, is my opinion, because I think stagflation is something really no investors have experienced, right? 8% inflation, 1% growth. It's not going to feel good for the long time. The 70s sucked. And I think we're back there. So that's the first thing I think about rent. Second, you're absolutely right. I've been doing this for 22 years. The worst time for a landlord for me was 2006, because tenants that I were denying were buying. I was like, how the hell does this make sense? So we did the whole 1 month off or half off deposit stuff. Again, effective rents. I've seen rent be flat in my market for 5 or 6 years. I've never seen it go down, as you've stated. I actually think we have had such a pop. Again, 30%, that's just bananas. I would not be shocked if there is real outright negative rent growth, probably 2-3 years out, as we get through a year of stagflation, which won't be fun, and then a hard landing, a recession. I just think some of this has to go backwards. And I think we have more and more people paying 50% of income in rent instead of the normal 33%. So it doesn't feel right with what I'm seeing going on. So there has to be an upper bound. So Jonathan, if somebody wants to follow you, because you put out a lot of great stuff, how could they do that?
So you can join my free Facebook group, which is the Multifamily Investment Community. Just search for it on Facebook. You can join my investor list by going to, Google Two Bridges Asset Management, LLC, and you'll find it. And you can fill out the investor form there if you're accredited. You can join my program by going to multifamilylaunchpad.org/join. And if you want to get a free download from me and join my email list, you can go to multifamilylaunchpad.org without the join. And you can see there's a great download there that's a checklist to basically the whole process of multifamily investing, syndicating, and everything in about 11 pages. So
very cool. Jonathan, thank you for giving back. Thank you for being here every week. Have a wonderful week. All right.
See you next week.